but we're wading into an earnings season. So how will the markets pan out in January? Sandeep Bhatia from Kotak Institutional Equities is with us now. Sandeep, morning. Thanks for joining in and a very happy new year to you first. How do you think the markets will wade through this earnings season, which generally is expected to be much better than the previous quarter?
Well, first of all, very happy new year to you and to your viewers. On the earnings season and the month of January, I think we have the benefit of a low base. That's definitely going to help us. The numbers are going to be broadly decent. We'll see good top-line growth. In fact, we could see top-line growth surprising for manufacturing companies. And we would also see margin expansion happening. So I would expect good numbers to come through across the board, across manufacturing companies. The only place where numbers could be a bit weaker is refining margins and chemicals. Other than that, I think broadly numbers should be good. The banking sector would have a bit of a tough time because last year second half we saw a lot of treasury profits coming through. So reported profits in the banking sector will not look good, but underlying operating earnings would track well. So on the whole, we are set for a positive result season in the Jan month.
Sandeep, morning. What is the run rate you're working with? Because for now, estimates seem to range between 23 to 25% in terms of earnings growth. What have you pegged in, and what do you think the leading contributor will be to earnings?
I think earnings growth for the whole market may not be as strong as 23 to 25% in our view. It could probably be in the region of 15%. Because, as we said, the largest contributor to earnings is the banking sector, which is not going to give that kind of earnings growth on the back of a very high base of second half. If you go back in time, you will see that banking sector reported actually stronger numbers than expected last year second half because of treasury profits and one-time gains. So those would actually weigh against strong earnings growth in the banking sector in our view in the second half of this year. So to that extent, our expectations of earnings growth is lower. The sectors that will lead the earnings growth on our view will be the manufacturing sector. So it will be a combination of automobiles, industrials, and also the tech sector will report good growth because we have seen good strong order inflow coming through. So broadly, these are the sectors which will report good YOY growth.
You spoke about petrochemicals as well. What are your expectations from Reliance in the current quarter, Sandeep? And how do you see the stock to move now, given earnings expectations and given the mild overhang of the treasury stake sale that they're doing in tranches?
I think we have been highlighting for some time that we would see pressure on margins and profits for Reliance, and we expect this quarter to reflect that. So to that extent, there would be pressure on earnings for Reliance. Other than that, I think most of the commodities are actually starting to do well. In fact, the month of January has been a month wherein commodities have flared up significantly. So things could definitely change even for Reliance in the second half of this year. So we are going through a phase where it's going to come under pressure for some time. But as I previously mentioned, the second half looks much better for these companies.
Just on that subject, Sandeep, how would you approach the steel space now? I mean, reports indicate that global prices are picking up again. But more importantly, I believe there is a restocking process that may have begun.
I think we have to put our attention behind something which is more global, which is happening. I think it is back to very good liquidity, which is why crude oil has started moving up. If you look at the entire commodity space, the most liquid contract is the crude oil contract. It's a standard contract. You can easily hedge it. So there is a lot of financial speculation that comes into oil futures. Once oil futures and oil prices, spot prices start moving up, the other commodities start moving up, and which is why we have seen across the board a rally in the metal sector. The other metal sector don't have such liquid contracts, don't have, the steel sector in fact has the least standardized futures contracts. Nothing like that exists. So to an extent, I would think that the huge liquidity which we have seen created in 2009 is still floating around, which is why financial speculation is back in the commodities markets. It is a rerun of what was happening in 2007. And what is happening in the steel sector is just a small fraction of what's happening in the overall bigger commodity picture, and which I think is not good for India. Lower commodity oil prices are something which will benefit India. It will benefit the oil companies with lower subsidies. So essentially all this which is happening is again an indication of the fact that liquidity which got created in 2009 continues to be available and is moving the markets in 2010 also. So which I think is a bigger factor than just steel prices. Steel prices are moving up because of improvement in underlying economies. But the fact is that the metal space and the prices in the metal space has moved much higher than most people expected in the fourth quarter last year.
Have you changed your view on Frontline autos at all going into 2010, Sandeep, on account of what you've heard over the last week or two, or do you remain bullish and you expect more outperformance there?
No, Frontline Auto will continue to trend well on the top line front, on numbers front. The big event which we need to face in autos is what I had highlighted before, which is the increase in taxes. We will see an increase in taxes in Feb, and that we have to see how the auto market faces that. I would not expect a significant dip in terms of volumes. But I think Q-on-Q and month-on-month growth rates have already started, flattening out, and that process will continue. So YOY numbers may look good, but month-on-month and Q-on-Q, the numbers would be flattening out. Therefore, the driver on an incremental basis for the auto company will be how they control margins. We will go through a phase in the first half of the year when they will see margin expansion. But if metal prices continue the way they have done, second half would be different on margins front for most companies. So clearly, probably in my view, the first half of this year is one of the best years in terms of best periods for most companies in terms of operating margins for companies in India.
What does this liquidity gush and earnings momentum mean for the market itself, Sandeep? Do you believe the first half could actually see the market get back to its previous high?
If you remember what we have been talking about previously, we said that in the first quarter we would see the impact of inflation, interest rates, and excise duty increases happen. So we expected some sort of resistance come through in the market in the Feb-March period. Now what's happened on that thought process essentially is the fact that inflation has moved up, but interest rates have not moved up. So clearly interest rate environment is expected to be benign in the first half of this year. Now let's wait and see what happens in Feb-March, whether the excise duty increases dampen demand. My view is that if interest rates are going to be moderate, then demand will continue to hold up. So that's what's happening in the real economy. On the liquidity side, I would expect continued flows at least in the first half of this year. So I would think the markets would definitely be supported by good liquidity in the first half of the year. We'll continue to see placements, new issues, QIPs happen. In the first half of the year, companies will see good margins, good top line growth. Margin pressures, if they emerge, will start emerging in the second half. So broadly, the market should actually do well on the back of good liquidity, and also the fact that they would see margins hold up much better, at least on a year-on-year basis. Things will look very, very good in the first half of this year.
Stay on, Sandeep.